Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name's Mark and today we have with us Richard Deacon of Octane Capital. Richard has worked in this industry for a number of years and is responsible for distribution, or has been responsible for distribution at a large scale of lending in the short-term finance space. So we thought it would be a fantastic opportunity to get an insight as to what the industry looks like at the moment, some of the challenges, and also some of the thought process that go behind that and how they help investors to fund some of their projects as well. So without further ado, Richard, welcome to the podcast.
Thank you very much, Mark, and thank you for having me.
No, you're very welcome. Very welcome. Thank you very much. Yeah, so we've obviously been having a bit of a chat before we started recording around some of what we're seeing in the industry. And yeah, it's just interesting that the landscape is starting to shift, I think, a little. So I think a great place to start would be around where you see the challenges for property, specifically property investing in 2026. I say the challenges, also the opportunities, in fact. I mean, I know the budget wasn't a rip-roaring success, but with all challenges come opportunities as well. So just over to you as well, you see that, what looking like for 2026?
Yeah, I think you've kind of nailed it on the head straight away, Mark, with regards to it's how you see the budget, for example. It's how you see the base rate for this year and whether you deem that as a challenge or an opportunity. I remember, if we can sort of go back around a year or so ago, that there was a phrase or a saying that was in 2024 that people needed to survive to 25 was the phrase that was being used, as in, let's get 2024 out the window and see what opportunities can bring for 2025, changes of government in the UK and abroad, question marks and uncertainty over base rate. You've got the cost of living, you've got the Ukraine war, etc. Now, moving on a year, and we're now in 2026 after what was a challenging year, I think is fair to say, in 2025. And certainly when I was talking to brokers, lenders, solicitors and other professional partners in my industry, in our industry, around the festive period, how's your year been? How have you found it? A lot of the guys were saying that, look, it's been a very good year. We've hit our target, or we've hit the numbers we wanted to hit, but we've never worked harder to do so. And I've felt that myself. I mean, I'm not getting any younger, but we've hit our numbers in Octane. Thank you very much. We've had a decent year, but it's been such a challenge to hit those numbers. And you try and sort of put, why is that? What can you learn from that in 2025 and take forward to this year? And there's a number of things involved. I mean, the first thing is, there's a budget every year. So let's get to the budget situation. There's a budget every year, and we as consumers and property professionals have little, if no, influence over what comes out of the budget, okay? So we've just got to accept what comes out of the mouth of the Chancellor and deal with it, okay? We can put an X in the box every 4 or 5 years for a change of government should we so wish, but with regards to budgets, we've got to just go with it. I think the main thing is where you are on the level of your journey in property investment. So whether you are, you don't have any property in your portfolio at the moment and you're thinking about getting into it, it's how you're going to take that first step on the ladder in your portfolio career. Are you an accidental landlord? Do you have one, maybe two properties that you're looking after and you're happy with them? You don't really want to do anything about it. And, what's your outlook? Do you want to sell? Do you want to hold? Where do you want to go with them? Are you a, small to medium portfolio landlord with sort of up to 10, 20 properties? Where are you going to go with that? What do you want to do? Where else would you invest your capital if you're not going into property, which is obviously a massive question? Or are you one of a bigger play, 50, 100 properties plus? And where do you go from there? It's a real bona fide established business. So I think for me, the 2026, I don't want to be sort of negative or anything like that, but there's always going to be challenges in every year. Hopefully there won't be any financial implications with regards to base rate. I think from people who I've spoken to over the last however many years, and certainly recently, the common perception is that base rate will drop slowly but surely to around about 3 point something percent this year. So we'd had a fall last year of 1.5, I think it was in the end, or 1.25. The numbers to certain extent are a little irrelevant. We are where we are now, and there are people saying that it would hopefully at some point next year start with a 3. So that's a generally perceived wisdom via several people in the press, in the lender area, in the advisor area. So you think, okay, it's not obviously not guaranteed, it's not going to be stable, but it's a small but steady decrease in rate. Fine, we're good with that. Then you've got to think, well, what else can influence my spending decisions? Well, housing market is obviously clearly one of them. What's the housing market going to do? And again, dependent on who you read the reports, whether it's Halifax Nationwide, Savills, JP Morgan, again, a slow and steady growth in house prices. But that is obviously very geographical, and you would be folly to start spreading your wings into new areas of the country for your property investment, and without incredible amount of due diligence and research into those areas first. And then you think, okay, well, if the base rate is going to be steady and slowly coming down, if the property market is going to be steady but slowly going up, that's a good thing, right? You're going to be having less interest on your borrowing, and house prices are going to go up. That's fantastic. That's utopia in an ideal world, which it is. But then you've got, further potential complications with regards to things that are outside of our control, like the wider economy, like the world economy, with regards to, let's just say, things that go on in the world that we can't influence, whether they are in Venezuela recently, of course, whether they're in America, whether they're in the Middle East, whether in Africa, China, Russia, whatever. Again, we can't do anything about that. We can only think what we would do should the worst happen and something bad does happen. What can you as a property professional do? Okay. So that's where we can plan for, the next first quarter, the first half of the year. And I think going to the opportunity for a second in 2026 is it's that planning phase. You've got to think to yourself where you are now and where you want to be at the end of the year. And it sounds quite obvious, but if you don't have that plan in place, and a real structured plan, a tailored plan, you might say to yourself, I want to buy my first property. I want to buy my 10th property. I want to buy my 100th property. That's great. But what's your plan to do that? And how do you work back from that plan? And I know we'll go on to it in a second about, teams and successful teams and stuff like that. But that's what I'm a massive believer in is, first off, it's so obvious, you've got to have a plan. There's no point in just saying, I want to be a property investor. I want to be a property millionaire. I want. We all want that we sort of can't have and are difficult to achieve. But it's having that step plan of, and people do it at the start of the year, right? So we're recording this early January, and, a lot of people say, I want to lose weight. I want to give up drinking. I want to give up smoking. I want to become a scratch handicap golfer, whatever it may be. And you think they're all brilliant goals to have, but you've got to think to yourself, losing weight is the classic one at this time of the year, where you think, right, I want to lose weight. I want to lose a stone, 2 stone, 3 stone. Fine. Get to your end goal. If I want to be, I'm 15 stone, so I want to be 13 stone, right? Well, how are you going to get there? and when do you want to get there? What do you want to achieve by doing it, and how you're going to do it starting from today or the 1st of January. And it's very similar to a lot of things, but certainly come from weight loss to property investment. But you've got to have that end goal and work backwards from it, because when you have that goal, you can work towards it, which is great, but have those interim steps as well. And I mean, one thing I've written down in my notes here is, I don't know whether we were going to talk about, people starting from scratch, but have a 12-month plan of what to do in 2026. And the first thing I've written down, funnily enough, is define your strategy. What is your strategy? There's so much available to us now in the shape of technology, whether it be AI, ChatGPT, chat bots on lenders' websites, podcasts, the virtual training that can be done via property professionals, whether paid or non-paid. There's so much information available to the investor at the moment. You would be folly not to use it, but it's how you use that information. And sometimes it's information overload. Sometimes you've got to pick the wheat from the chaff, if you will. But for me, the challenges are there are going to be a few challenges in 2026 that you and I don't even know about yet, Mark. Whatever that may be, there's always something that crops up, whether it's Brexit or COVID or, say, Ukraine war or cost of living crisis. At the start of those respective years that are only recent, no one knew that on January the 1st, that there's going to be quite a substantial happening in the world that is out of our hands that we can't really do much about. So it's having that goal and thinking, what if something happens? What if base rate doesn't come down? What if borrowing stays the same? What if house prices slump instead of increase? What can you do about it? But I think having this, opportunity for 2026 is there's always opportunities everywhere you look, right? So I don't think 2026 has got to be a specific opportunity. If you want a soundbite from it, it would be that base rate will be the lowest it has been in the last 5 years or 4 years or whatever it is. So that's a fantastic time to borrow money, okay? But then 2027, I know we're talking a year ahead, could be even a better time to borrow money. So you've kind of got to make that decision where you're going to pull the trigger or push the button, call it what you will, to make it this year and have that clear plan, that clear strategy of what you're going to do.
Yeah. Okay. No, fantastic. I think there's quite a lot to unpack in there. Quite a few bits. So I think making notes as you were speaking then around the challenges and opportunities that 2026 has to offer. I think it's true for anything, business as a whole, not just property investment. I think off the back of the budget, we just need a degree of stability. There's been too much fluctuation, too much change. It's really hard. So the best made plan in the world could be ripped up and started again because of, fiscal policy and all of these sorts of things that are going on at the moment. So I think hopefully off the back of October, whether we like what the outcome was or not, we just want a degree of stability. So these are the rules of the game, just get on with it and that sort of thing. So I think the issue that we've had historically is that change has been happening too fast to be able to adapt, and property isn't a quick win sort of strategy. Therefore, it takes, I would argue, roughly 18 months for any change in budgetary policy to then manifest itself into the market. So you're playing 18 months behind the game almost when we start to see that habit happening. And the reason for that is there's a lot of deals in pipeline. Correct. That are already committed to that need to fall through. So, so there is always a lag in the system. So stability will hopefully help everybody, business as well, just to make some good quality decisions going forward. So that's hopefully something we'll see off the back of it. Yeah, you mentioned strategy as well. Myself and my partner, we sat down over the festive period. We sort of do a review as to where we're at, where we want to be. Funny enough, it's a little bit like, there was a meme I saw, it's a little bit like playing Monopoly and going around the board and just collecting the £200 every time without buying anything is just madness. You wouldn't play the game like that. So therefore, you need to sit down and have a strategy in place.
Absolutely.
Are you buying Park Lane? Are you whatever you're doing? It doesn't have to be property, but you need a plan, a strategy if you want to move forward anyway, that's for sure. So we sit down and we revise that. And like you said, starting with the end in mind, where do we want to be? What do we need to achieve? And actually what that informed us was the perception was your BRR single fixer-upper type thing is simply not going to get us to where we want to be in the period. Now we have to go through, and we'll come on to this in a minute, we have to go through the ladder of complexity. You can't just run straight to the £1 million project. But likewise, you have to have a line of sight as to how do I get myself into those and so on. So yeah, totally agree with you on the strategy thing. Interest rates is an interesting one. You obviously mentioned around macroeconomics as well. I would have said that the next 12 months we'll probably see some stability on the interest rates. Given what Donald Trump has just done, I suspect that may or may not be the case. I think we'll find a bit of volatility in there because we just don't know what the fallout is going to be on what he's just done.
Yeah.
And there's also talk of Greenland as well, which has come onto the space as well. So I just think that might just create some unease in markets, as always does. So I don't know. We'll wait and see what happens in that. The point being, though, is, and we see this so much, not just in developments or short-term lending, but in mortgages, in indecisiveness, rather than actually just making a decision, living with it, and never looking at interest rates ever again for the next 5 years type thing. You make your decision. If the deal works at the interest rate that is now, just do it.
Absolutely. You've got to have that, because you can't, try and think, I'll be a crystal ball. And as you say, I think if interest rates come down, it'll be cheaper. I want to borrow 100,000, £500,000, whatever. Then, an interest rate coming down that's passed on through via the lender, well, that might save me £10,000 on my project if I do it this time next year. Well, you think, okay, yeah, it could well do. But then what are you going to do for this next year? Just sit on your hands or something. So, it's so important to have that, in my opinion, and you've obviously got a similar opinion, Mark, is have that mindset of, the price will be the price will be the price. If you wait another year to save £10,000 in interest on your project, well, the cost of materials, the cost of labour, the cost of your acquisition might have gone up by £10,000 anyway. So, and you've got to have that built into your calculations. I mean, we can move on to that in a moment or whatever, but don't, pull the trigger, do something now that is part of your strategy, or else what are you going to do? It's such a, it's a big thing of mine, that.
Yeah, I know. Whilst absolutely, the cost of finance is important because it does find its way directly to the bottom line of a project. I get it, absolutely. But if a 0.5% interest rate makes or breaks your deal, it's fundamentally not a deal.
Not a deal, right.
Therefore, so for me, interest rates and saving 0.5% optimizes your returns, doesn't make your returns. Therefore, if you're having to sit and wait on that, as you say, there are other issues around build costs, planning processes and all these other factors which would play into that, which are far more significant than a 1% interest rise or decrease and so on. So, and we're talking more around the project-based stuff as opposed to your assets that you already hold. 1% might actually, but the rents have gone up as well significantly. Therefore, you should, again, there's another argument, there's far more profit in it. So 1% shouldn't be there. You should always, in my view, sensitize your deals anyway, whether that be your portfolio or a project, to understand what your failure point is. And we've done podcasts on that as well. So that's interesting. And yeah, you touched upon this one as well, is your new entrant into the marketplace. I guess I would argue it's easier for the new guys, and hear me out here for a second, is the guys that have been in the game for 20 years have done business or have seen business happen 15 years ago when the rules were different and it was easier. There was less friction in the process, the planning and all of that sort of stuff. And that may be true, but coming in, you aren't tarnished by that's changed. Ultimately, the rules of the game are this as of day one, and you kind of just got to get on with it. So you aren't tarnished by that, it used to be like this, and it was back in my day, and that sort of stuff. So you're not bringing that legacy information with you, and you just actually come in and you go, well, I didn't know it to be any different, so I just got to get on with it. And those are the conversations that we're starting to see. Actually, they aren't bogged down in the change that has happened over the last 2 years or what have you, because they just didn't know about it.
Yeah, exactly that.
Yeah.
And it's as you say, it's quite encouraging, quite refreshing that, we've got people coming into the game. They'll come into the game this year in 2026 that they've never known what effect Brexit had, or they've never known what effect interest rate rises or falls have had. They've never known, 95% self-cert any mortgages back in pre-credit crunch days. And whilst, we have, and I think we can garner our experience on this and use our experience of, if it's too good to be true, it often is, and, what's coming before a big recession or what's coming before a good time to buy. Hopefully we can use that experience. But as you say, people coming into it now, they don't know any of this stuff. And it's just, right, this is what my plan is now. Can it work on this as of today? 1st of Jan 26? Yes, it can. Well, let's go for it. I don't really care what happened in the past, because one thing's for sure, Mark, what you and I can talk about for the next however long, we can't change what happened in the past. We can only look towards the future. And this is what, I tell this to my guys, I tell it to my children, for goodness sake, you can only influence what is going to happen in the future. You can't change the past. So, maybe learn from the past, certainly learn from your successes, what was successful, and as your mum and dad always say, learn from your mistakes, of course, but then bring that into what you're going to be doing going forward. But if you haven't got a past in property finance or property portfolios, well, you haven't got a past, so you can only look towards the future and plan for that successfully.
Yeah, definitely. And that's where I think the role of brokers, lenders, solicitors, valuers, etc. are there. So, we see individuals who step in, they've got a pot of cash and they do cash only deals, so to speak. And we've seen, as much as being a cash buyer is a great position to be in, it comes with its risks, which are undisclosed in so much that you don't know what you don't know. And what looks like a good deal means that you have the freedom to make a decision without the input of a third party. When you are coming to use lending, you've got a valuation report, a valuer, you've got the lender and their knowledge and their past experience of what has worked and what hasn't worked. And, we're all seeing hundreds of transactions a year. And there are themes within all of this, the ones that work, the ones that don't work. And there are lessons, there are templates to follow where it will or won't work off the back of that. So, and I think that speaks to our role then as professionals, as to actually lenders are there to give you the facilities to achieve what you want to achieve. However, they act as a little bit of the gatekeeper. Does this make sense? Yeah. It's our money, absolutely. You want to borrow it, but lean on our experience as to, hang on, I don't think it's a deal you should be doing in actual fact. So that's useful as well. Okay, so Fabus, thanks for that around the 2026 outlook. I think if we drill down then just a little further as to where inquiries come into yourselves, whether it be direct from a client or via a broker or whomever, what are the top 3 reasons, or what reasons do you come across that you end up ultimately saying, no, this isn't one for us? So what I'm kind of getting at is, what are the barriers? And as I say, there are themes and there are templates. Whilst we want to, obviously, we remain positive and say, we say yes to a lot, we also say no to quite a few things as well. And what are the themes that we're seeing that ultimately lead to no in some of the deals that you've seen over 2025? Yeah,
that's just such a good starting point. I'd say probably the number one is the valuation of the property. We talked earlier about down valuations, and you're absolutely right in what you're saying. People say, the surveyor downvalued my property. It's like, well, not, he hasn't really, unless you've got a comparable valuation recently. The property has been put in at a value which you thought was higher. So, that's not a down valuation. You thought the property was worth X, a value has come out and it's worth Y, so you were out. And they'll give you all the reasons under the sun why no, it is worth X because of this, that and the other, which is fine. But I think and there's obviously a huge difference between valuation and purchase price. We are generally accepting that purchase price and valuation will be the same, very roughly. There's got to be a real good reason why a purchase price is below what a RIC surveyor would value the property at. And there are genuine reasons. But my sort of rule of thumb is if someone says, I'm buying a property for, I don't know, £200,000 and I'm getting it undervalued because I think it's worth £220,000. I'm getting it because I can move quick, or I'm using bridging finance, or whatever it may be. Well, when it's a relatively, £20,000 is a lot of money, but 10% is a relatively small, below market value transaction. 99 times out of 100, a surveyor will value that property at £200,000 because it's what the person is buying it for. What quite a few people don't understand or cannot get it in their head of, but I think it's worth 220,000 because of comparables, because of this, that, and the other. But a property is only worth what someone's prepared to pay for it, and this is where Rightmove is great, Zoopla, all the tools that we have available to us with regards to trying to get an angle on evaluation of a property before paying money for a surveyor to go out there. They're great, but in essence, you're paying 200,000 for that, and next door sold for 220,000. You go, okay, right, fine, that's a really good comparable, but there's an awful lot of differences between two properties, even next door to each other. It's the timing, it's the condition. Was there a planning plan place? Was there a speed element to the transaction? Was it a distressed sale? There's so many variables that you've got to buy what's right for you. And we talked earlier as well about your model, your financial model. Will that work for you as well? So I think valuations is one thing that we have an awful lot of. We'll go back to the broker or the client and say, look, we don't just, there are lenders, hundreds of lenders out there, certainly in short-term finance, that will go, okay, we'll take this, we want this deal, we want to get this project on, and we want to help you. But how we look at it is, well, being frank, we don't earn any money, until a deal completes, right? Well, actually, until it redeems, but until it completes. So there's no point in getting a deal into someone or even, an application and starting the valuation and the legal process if we don't think it's worth, in this instance, £200,000 or £220,000. Because if it doesn't work at 220,000, then it's not worth anyone doing it. So we'll go back often to the broker or the client and say, look, we've had a look in various plannings and Rightmoves and Zooplas and Land Reg and comparables, and we've done our due diligence and gone, we don't think this property's worth 220. We don't think it's worth 200. We don't think it's worth whatever it may be. Why do you think you're getting it for below market? Why are you paying what we think is vastly overpriced for the project? And that's where I think we add value as a lender, because we don't just accept what they're saying. It's what, client's buying this is 200,000, he's going to do a refurb, it's going to be worth 290,000 at the end, and he's going to refurb. We go, okay, cool, but why do you think that's worth that? We've had a good look at this, and we just can't see where you're getting this value from, or the yield, or whatever it may be. So we want to say no to a deal if it's not right. There are other lenders who'll just accept and crack on and all the rest, fine. But we don't want to be busy fools, and we don't want our clients to, make a mistake or an error in their numbers,
Yeah, no, it's and it's an interesting one. There's that saying, isn't it? Whereas a quick no is way better than a long drawn out process. And also, those lenders that do just take it on face value and just say, we'll just get the value. You could be 5-6 grand into surveyors and valuation reports to ultimately come back and said what your gut told you in the very outset, which is, and as you say, you guys don't make any money off the back of that. All right, some lenders may charge a £200 application fee or something, which, clearly isn't covering the time spent on it. The only winners in there are the valuers and the QSs. because they're just getting instructions for the sake of getting instructions. So I agree with you on that one. So there's a make sense piece on that. One of the things we tend to do is, so whilst we won't necessarily comment on the end value, that's not for us to really to go away and research for them. We would ask about the due diligence, absolutely. What we tend to do is to sensitize that end value, say that if it's the GDV, the build costs, or the purchase price, we run the sensitivity on that and understand at what position does this project fail. So if you're telling us that you're going to refinance out at the end and you want, you can't afford to leave your 200,000 in there, you need to recapitalize 150 of that and so on. So we run the numbers then to go, well, actually, okay, your 290 valuation, that's great. That gets you to your number one objective, your holy grail objective. What happens if it comes in at 285, 280, 275, 270, etc.? And at what point does that number then cease to make any sense? And how many steps away from that number are we? If we can afford to go all the way down to 250, then that's, what's that, 20% or whatever figure that is, that's quite a margin for error. If we can only afford to go down to 285 before this ceases to make sense again, then your margin for risk is tiny. And are you willing to put your money on the line for that sort of thing? So we tend to run it that way, and understand, okay, what are the variables and what can you tolerate in this before it ceases to make sense?
And that, I know we touched on it earlier as well, but that's part of the planning process, isn't it? You think you can do as much mathematics as you wish to for, purchase price. We do an awful lot of refurbishment finance. So purchase price, cost of works, whether it's cosmetic or you're putting on a side and rear extension or something, and then the GDV. Now, the GDV is the holy grail figure, which I quite like that. If the GDV is whatever you think it's going to be, your maths are worked out right, and you've got, you put in a 10, 15, 20% contingency, you've made X amount in profit, or if you're not doing it as a buy and resell, you're doing it as a buy and keep. Is the yield sufficient? Because most lenders won't be too fussed about, the margin on the back end if you are obviously keeping it. But if it's a resale, well, you've got to think that several different aspects that you've got to think about, which is the cost of work and it is the GDV. But then the GDV is only going to be valid for what someone's prepared to pay for that property. And if that doesn't, materialise, well, where are you going to be? Well, how long are you going to have that property on your books for to sell at the GDV price? When do you start going, okay, well, the GDV of £300,000, hasn't been achieved in 3 months on the market. Well, what do I do now? Do I try and do it, to knock it down to 285? Okay, 285 for 3 months. But suddenly it's been on the market for 6 months. You have had a snick and you're down to 285. To your point, where do you come down to? Where's we call it an exit route, obviously, from our loan. Where do you get out that is profitable for you, and what can you do about it? And that's the real big question mark about getting your numbers right and putting in enough fat, if you will, that your numbers still work. But there'll be another point where it doesn't work and you just got to tap out and go, no, we're out of this. But it's having that knowledge, and they've done that to knowledge and expertise. It's having that knowledge and expertise of, I know that my nub point is 250,000. So we can get down to that before I'm underwater, or at worst I'm level par. But, we're with GDV of 285-290, we're fine. But how long will that take?
Yeah, no, I agree. I think something else that we need to consider as well around the valuation piece, especially in a refinance, is does it make sense? So, for example, if you're buying it for 100,000, you're spending 10 on it, and you're now saying it's worth 250. Even if you've got a valuation report that supports that from yourselves, so I say from yourselves, from the valuer, and we can lend off that basis, trying to get a mortgage lender to accept the new value and that uplift is very difficult. The lender, if you do this within a 12 months, or certainly within 6 months, you'll revert back to the purchase price plus refurb costs, and that'll be your total refinance. So again, whilst you can get a deal done, if your plan is to retain it, again, does that actually fit into the exit strategy that you've got? Obviously, if you're selling it, that is a non-conversation. again, we would also argue that you probably want to run both scenarios, sell and refinance, so that if you can't sell and the sales price at 250 takes you underwater, then you may have to refinance at 260 just to hold it and then sell again in 2 years or whatever that may look like, and so on. So, and it comes back then to that opportunity cost. Does getting out of that project mean you can get into something else, take the lessons you've learned off of that one, plug it into the next one, and so on and so forth. So yeah, so valuations definitely are a huge thing. I don't think they'll ever not be. They're the crutch, I guess, to all lending deals from that perspective. So fantastic. Any others that you've seen, themes as to barriers or reasons why you may say no to lenders?
Yeah, so I mean, the other one, you've sort of touched on it there, is realistic costs. And the big one is the refurbishment element to any project, really. I mean, I've done development finance in the past, but that's a big animal that I don't really want to go through here. But refurbishment of, residential properties. So, there's sort of, a lot of lenders classify refurbishment as light refurbishment or medium refurbishment or heavy refurbishment, which is fine, because things, a lot of lenders like categories and stuff like that. But certainly at Octane, we just classify it as refurbishment. So whether it's, a change of paint and kitchen cupboards and a fresh bathroom, right the way through to reconfiguration of a, 3-bed house into 2 flats, or, a 4-bedroom house into a 7-bed HMO under sui generis planning with a side and rear extension and 7 ensuite bathrooms, we classify it as refurbishment. And the thing that, probably next after valuation that we, come back on the most is the cost of works and the schedule of works, because, some guys and girls out there say, I'm a handy with my hands, as it were. I'm going to do a lot of the work myself, certainly at weekends, holidays and what have you. And you think, okay, fine. So you're going to convert, let's say you buy a property, we use the number 200,000, so let's carry on. So you're buying a property for 200,000 and you're going to convert this very tired 3-bed semi-detached house into 2 flats, just for argument's sake. Come to us with a schedule of works of £50,000. And you go, okay, fine. So you look at the schedule of works and you think, well, you've got 2 kitchens in there, you've got 2 bathrooms in there, you've got a reconfiguration of the property in there, you've got boarding up of walls, you've got knocking down of walls, you've got this, that and the other. And this is before, you've done the cosmetic stuff. And you can do it all for 50 grand because, I know someone who fixes kitchens. I know someone who's Sparky, and he'll do all my electrics for me because he owes me a favour because I did this for him. And, the Chippy, the carpenter guy, will do all the work for me for half price because he's done. And you think, that's brilliant. That's so good that all these people who are doing it for free or on the cheap or whatever else. And that's why your cost of work is 50K. But you've got to look from a lender's perspective. And, I want it to be a positive thing, but from a negative side of things, lenders will always look to say, if this deal goes wrong, how am I going to get my money back? And that's whether you're a tiny little lender doing 1 or 2 loans a month, right the way up to, the big banks and building societies. They lend money, they charge interest on that money, and then when you pay them back, they get their profit. Now, once they lend the money, if they think there's risks involved to not getting that money back, they'll look into those risks. And one of the risks specifically here is your cost of work is just way out of whack to what we think it might be. We'll send an asset manager out, or we'll even do our own due diligence on the deal, where it says, you're never going to convert a 3-bed house into 2-bed flats for 50K. It's going to be near 80, 90, 100,000, depending on finishes and stuff like that. Because we've got to take into account that if it all goes wrong and we have to repossess that property, we have to put it right. And we don't know Uncle John, who's a carpenter, or your mate down the golf club, Joe, who's a spark, and you can get it done for free or cheap or whatever. We've got to hire a professional to do this and pay, probably full whack for the materials. So that's how we look at it as a lender. But notwithstanding, if they're a professional, as opposed to, say, a first-timer, and they say, no, I've got a team who do this way, I've got plenty of in my portfolio that we've done this on, and I'm sharp as a tack with my costs, then you've got to look at that and think, well, do you know what, as a professional, yes, you probably should be able to do it, not for 50k, but for maybe 70 to 80, whereas our costing would say 80, 90, 100. You think 50k's out of whack, you're at the lower end of ours, fair enough, you're a professional, well, let's go with that. But the amount of times we say, we don't say no to the deal, we just say, look, that deal can't work for us as it's presented. You'll need to have a think about costs, because this is what we have found, and this is what and you generally get it, the less experienced people who will come to you with the very low cost of works. And then even then, a low cost of works will only get, say, bottom end of GDV. And you think, hold on a second, if you've got a low cost of works and a low end GDV, well, it only needs a tiny bit of, perception being wrong. The deal's not going to work. As we talked earlier, the deal's dead, the deal's underwater. So getting your cost of works accurate is key, and building in, we usually say a 10 or 15% contingency. And then when you go back and say contingency, and people say, okay, contingency of 5k, that's a 10% contingency on a low cost of works anyway, so we're going to struggle here, so that's a huge one for us, cost of works.
Yeah, and I think touched upon something there as well, which is the nuance between somebody who's new in the space and somebody who is experienced. So, and we spoke about this prior to jumping on the podcast, was one of the things that we encounter quite frequently is the person who is lesser experienced, should we say, will come to us and say, but my mate was able to borrow he did 100% bridge loan, or he was able to do it at that. But however, there are nuances within why that individual perhaps was able to do what he did. He might have a £2 million unencumbered portfolio and therefore, can afford to do it 100% leveraged and so on and so forth. The other piece there being is, well, actually my mate got away with, but my mate managed to negotiate a lower build cost. Well, yes, because he probably has, 6 projects that he can demonstrate that he's delivered on time, on budget, on profit, and so on. Therefore, he has more weight in his, I can do it for this. You have nothing or very, very little. And therefore, we have to lean on the professional who we trust at this juncture. Yeah. And as you become more experienced, then your credibility will go up. And therefore, that weight or that dynamic will shift from the valuer back to you, because, okay, we've got the evidence now. We won't ignore the valuer, obviously, but you have more weight in your negotiating skills to say, well, actually, I disagree with that as well. So, and therein lies the nuance between new and experienced. If you can back up, this thing is always about, can you do what you say you're going to do on time and on budget? Correct. Otherwise, we don't get our money back, and everybody, everybody pays, as it were. So the other thing that was interesting that you mentioned as well, and I do often wonder is, and I guess it's a case-by-case scenario, as to whether you actually, with the step-in rights, whether you actually do finish the project and in order to recover the monies, or whether is it a case of you will then sell it, but with the build costs, you'll do with the residual value to market it to hopefully get that sold out. What is the preferred route then from your guys' perspective?
There's no preferred route, Mark, to be honest with you. I know it sounds a bit bland, the answer, but it is on a deal-by-deal basis. And it depends on where they are throughout their project. It's where we are from our funding model as well. So, how much have they borrowed? What loan to value are they? What loan to value are they going to be at the end? Has the project thus far worked? What works have been undertaken so far? And can we step in halfway? Is it worth our while finishing that off to then sell it? Because that might take another 3, 6, 9, 12 months sometimes. Or is it a case of this particular project in this particular area at this certain level is absolutely right for someone to take over, and there's money in the market, as the phrase goes, to sell it as is to an investor. Because we're lowly geared, we can get out, we can make our profit on this thing now, standing as a shell or whatever it may be. Or it might be a case of, no, that won't work in this area, won't work with this project. We're at our highest gearing, our highest part of the risk curve. We need to do this ourselves. So it really does depend, to be honest with you. But one of the, just going back a second with regard to sort of costs and all the rest of it, is a misconception that, we've got a sort of product guide that we work towards, that we'll do, 75%, generally speaking, of purchase price, and we'll lend 100% of costs. And that's great. That's a decent, thing that some of them do, and we'll go up to 70% of the GDV. But that's not for everyone, if that makes sense. Lenders do lend to people as opposed to the project. If you come to me with a project and you've got someone, it's their first time or second time doing it, and they're working on a shoestring budget, and they haven't got much on their portfolio, but we could lend them 75% of purchase and 100% of build. Or will you lend that same level of money to someone who is on their 10th project? They've got a portfolio behind them, they've got 2 million quid worth of unencumbered property, they've got a strong net asset value, they've got a professional team in place that does the work, and they can evidence this, of their profit and loss over the last 5-10 projects. Well, as a lender, you're gonna back that company or person more than you're gonna back someone who hasn't got that. And it sounds, I don't know how it sounds, if I'm honest with you. I've worked for a lender for that long, but you kind of think, well, shouldn't it be, you say you do 75% purchase price and 100% of work, well, shouldn't it be for Joe Bloggs as well as Billy Smith? And it's like, well, yeah, you can, but you're going to back the guy with the more experience, or maybe lend him a bit more, or maybe not ask for so much information. And I think one of the questions that was sort of asked of me going into this is, what does your ideal customer look like, or something like that? And it's not necessarily, someone at 50% loan to value, or, who's putting $1 million into the property. It's the repeat borrower, because, we spend a tremendous amount of money on advertising, on BDM salaries who go out and meet clients and brokers and all the rest of it. But the one thing we want, the holy grail, we used that word before, is a repeat borrower who has come to us, who's borrowed money, has successfully bought property, transformed it into 5, 6, 7, 8, 9 bed HMO, or 2 flats, or just really reconfigured the property to a really high standard, sold it and paid us back, and done that 2 or 3 times. We've got some guys on our books now who, I'm being a bit flippant, but they'll literally phone us up and go, oh, hi Rich, I've got a new one. It's number 1 the High Street in West Hampstead. I'm buying for 300,000. I'm doing 75 of work, and the GDV's 500k. We go, yep, cool, no worries. We'll send a surveyor out. We'll do this, because we trust his or her figures. They proven to us time and time again that they can deliver a project on time, on cost, and pay us back within time. So why wouldn't you back that person, more? If it was your age-old saying in this industry is, would you lend it if it was your own money? And you kind of think, well, yeah, for a property professional, I would lend my own money to that boy or girl, because they've got a proven track record. If they don't have a proven track record, you'd still lend your own money, but you'd be a little bit more, or can I just have a look at the figures again? And, why are you buying this project? What is it you want to achieve out of it? What if something goes wrong? What have you got in the background? What is your net asset value? What's your asset and liabilities like? Have you got any history in your employment where you just walk away from stuff, because you want your money paid back to you? So we do back the individual as well as the project.
And that's, it's the thing we keep talking about all of the time. This conception that a lender says, no, yeah, it does exist. It absolutely, computer says, no, it does exist. It exists in your mass market, low cost borrowing, typically in, easy access mortgages and that sort of stuff. There has to be a way, and I'll come on to why that is in a second. Obviously, how you deploy your capital is exceptionally important. The risk, so those that will lend at those levels, you'll pay a premium for that to get it. So it becomes then, again, my mate borrowed at 7%, now you're charging me 12. Well, actually, yeah, he's your repeat client who and the risk of getting that capital back is quite low versus we don't know you. You want high leverage, and therefore it's risk. Everything's risk based, and the pricing will reflect that. And I think it's worth repeating, actually, just for the listener's sake as well. Around there's this misconception around how much profit actually lenders make when they lend money. So let's take typical bridging rates, 1% a month. There's a pin in the board there, 12% per annum. Oh, that's expensive. What people forget is the cost of funds in the first instance. So let's say, I'm going to make this up, let's say you're borrowing in at 6% from source A. Bear in mind, in order for source A to lend it to you, they probably have to, it's from a bank, and they have to pay interest to the savers and so on and so forth. So there's a cost to acquiring this capital in the first instance. In addition to that, we've already touched upon the cost of getting that money out in the first instance. So your BDMs, your processes, your underwriters, and all of those, and getting it through the legal process to get the money out. And if you were to lose that money, and this was always the thing that we had in our mind when we were with HSBC, you're let's say making on average 3% margin per annum on the money that you deploy. On 100,000, you're making $3,000. If you lose that 100,000, that's a hell of a lot of 100,000s. You've got to relend just to make that $3,000, just to recover the capital. So that's not even profit. That's just to recover your loss off the back of it. So I think people just think, oh, this is expensive money. There's a chain and a process and a cost to delivering that money. Now, you can borrow from a private individual. Absolutely, you can. And you may be able to borrow at 7 or 8%. Well, the reason that is because they don't have the cost of funds. It's their cash. They don't have the process, the salaries and so on to pay, but then you perhaps don't have the experience to go and lend on, and you can catch a cold lending money in that way as well. So I understand that exists. So I just want to re-emphasize really around, if you lose that £3,000, you've got to put way in excess of £1 million back out there. In fact, it'd be more than that. It'd be more like 10 million just to recover that 100,000 capital lost. So this isn't a decision that can be made lightly. Hence the reason you want to back people as well as projects, and you want to trust the person who's got your money that they're actually going to give it back to you with, yes, the interest, but it's only a small margin that you get back that actually counts as profit.
That's correct. Absolutely right, and it's something that a lot of people don't understand. And you've explained it quite well, Mark, with how it works. And I'm touching wood as I say this, but in 9 years of Octane being in existence, we've never had a capital loss. There's always one or two deals where you might not get the full interest amount from it, but we've never had a capital loss. And in my previous firm, never had a capital loss as well. So that just sort of goes to show the stringent underwriting, you could say, or sensible underwriting is probably the other thing I'd say as well. There are other lenders out there who probably have taken capital losses because they've, lent sort of a high leverage to a low price to an inexperienced client that, it's just fallen like a pack of cards. But to your point earlier, and it's a classic, one of my sort of saying that I've said for years and years, when people say, 1% a month. I mean, when I started out, it was 1.25 a month and 1.5 a month, and that was the norm, 20 odd years ago. And it was like, that's really expensive. And I go, okay, compared to what? And they say, oh, well, I can get a mortgage for X, Y, and Z. And I used to just shrug my shoulders and say, you go and get a mortgage then. Oh, well, I can't get a mortgage because they won't allow me to do works, or I can't get a mortgage because I'm buying for auction. I need the funds in 28 days, or I can't get a mortgage because I've got adverse credit, or can't get a mortgage. I haven't got my books for the last 3 years. It's like, well, you can't compare it to a bridge then. A bridge is, well, certainly for Octane is very much You buy a property that the high street either won't touch because it's in a poor condition, or it's semi-commercial, or it's got a planning gain on it, and you're going to alter that property, you're going to refurbish that property, you're going to change the use of that property. Well, your normal mortgage companies won't allow that. That's not what they do. So you've got to go to a specialist lender, whether it's ourselves or one of the others out there, to do that project. And I think maybe it's a bit less nowadays, but certainly I still get it every now and again. Oh, that's really expensive. And all you're doing is you're dealing with people who are not used to bridging, which is absolutely fine, because, before I got into bridging 20 odd years ago, I used to work for a mortgage packager, and I used to do buy-to-let and resi mortgages. And when, I first heard about bridging, I was like, oh, that sounds expensive, and it was, we'd say $1.25, $1.50 a month. That's really expensive. But when it was explained to me how bridging works and how you can, as a client, you can earn money off it, and as a lender, you can earn money off it and then recycle that money, because it's quick, generally 12 months or so. Then I got it, and here we are all this time later, and people still say it's expensive, but you've got to be realistic, compared to a mortgage that you can't get. So,
yeah, and it's, we always phrase it, it's just the cost of doing business. If there's an opportunity, the cost of this should be absorbed by the project itself. If it doesn't, then it's not a project, and if you're having to go and, as I said before, if it's a question of borrowing at 12% versus borrowing at 6%, and the 12% doesn't work, but the 6% does, I'd argue there's not a deal in there. You're overly reliant on the cost of funds, which, as I say, is something that should optimize a deal as opposed to make it.
Absolutely.
From that perspective. So, yeah, that's interesting. As you say, probably less so now. I think now that bridging is growing in popularity and people are seeing the potential that bridging has to offer, we still do get some pushback. And the other thing that we try and share with clients is, a percentage is a percentage. It's relative to the number that you borrow, irrespective of what that number is. For me, the barriers are in bridging, and where bridging does feel expensive is when you want to borrow the lower figures, because the broker fee is still the same, the solicitor fee is still the same, the valuer's fees are still the same. And when you start to add all of these things together, that can equate to 10% of a deal. If you're borrowing 50,000, £2,500 in solicitor fees, say £2,000 in a valuation fee, £1,000 in a broker fee, that's £5,500, £6,000. That's more than 10% of the cost is borne out of just fees. They're fixed costs. Now, if you're borrowing 500,000, the valuation fee is still £2,000, the solicitor fee is still £2,500, and it now becomes 2 or 3% of the deal. So, proportionately, the smaller the figure you're buying, it is going to feel expensive. So, as you go up the scale, those fixed costs, the professional costs, which have to be in there, will make a smaller part. You'll just be, that's just the price of doing business. So,
And that's a very valid point. And, it's not a selling point at all, but we've upped our minimum loan recently to 175,000, not for any particular reason, but going back to your point of if you want to borrow £50,000 and you're working towards kind of the lower end of the property market financially, if something goes wrong, you've got a much higher propensity that whole deal will go wrong, and you do end up losing money out of the deal, because say your fixed costs remain the same, and then if something untoward happens with your refurb, then even if you go over by £1,500, well, that's suddenly another percentage that you're going to be struggling to make on the back end. You suddenly can't make someone buy that property for £1,500 more if you're working on the back end just to get your costs back. It doesn't work like that. So when you're dealing on the lower end of it, you've got to be ultra laser focused on your pricing. And if it doesn't work, it doesn't work. Move on to the next one. You can't just go. It can't be an emotional thing. It's got to be a statistical spreadsheet thing of, this simply doesn't work for me financially anymore. I'm going to move to the next one.
Yeah, and we do see that. We see that in commercial as well, around minimum loan sizes and what have you. And again, lenders like, well, don't they want to do business? Or so it's what type of business do they want to do? And equally, I use this analogy as well from a startup business perspective, as opposed to just property. Is 50,000 in the grand scheme of property is entry level. 500,000, million, that's where a couple of 100,000 plus is where the real deals in effect operate at, given property values. You wouldn't say that in Wales, but certainly outside of Wales, that would be the case. But when I liken that to somebody who wants to go in and start up a business, anybody can go past, you can start, nothing against window cleaners, but you can start up a window cleaner business today, walk into a bank and ask for £5,000 tomorrow, get your bucket and your tools and your fairy liquid or whatever, and you can shut that business down tomorrow. Anybody can ask for £5,000. Yeah. To go in and ask for £1 million, you have to have something about you. You have to have thought about it. You have to have a business, but you would have a business plan. You would understand your industry. You'd have background experience. You'd have seen the opportunity. You'd understand the opportunity, the cost, the pitfalls. You would have gone in and had to have something about you. You may not have millions of pounds worth of assets behind you, but you would have given it some real consideration.
Yeah, it's good.
And it's the same with property as well. So anybody, dare I say, can ask for 50,000. To go and ask for 500,000 is a very different question. And you want to put all of your wealth on the line for 500,000 versus 50,000? Well, you can work yourself out of 50,000. 500,000 loss is quite different from that perspective. And that's where I think the difference sits is you're planning to borrow 500,000 has to be far more robust than borrowing 25, 50,000.
Yeah, I couldn't agree more. And as you say, you wake up with £500,000 worth of debt, you're going to make that project work. You wake up with £50,000 worth of debt. I mean, £50,000, let's not dumb that down. If we put it on the table in £20 notes in front of us, we think about it. But, as you say, you can get out of that. And that's where, going back to the professionalism of our industry, and also the people we want to deal with, and not necessarily we give you said earlier, you give more experienced people cheaper rates. That's kind of not how we work. Our rates are our rates. It's just the level of risk that we go to, and we are going to always go to a slightly higher level of risk with the seasoned, experienced individual than opposed to someone who's, as you say, they're borrowed up to their hilt. They've got no experience. They've got none of their, that's a very old-fashioned phrase, but they've got no skin in the game themselves. It's all what we call soft equity. It might be second charges here, or it might be JV partners. They've not put any of their own physical cash into it. And then when you have put your own cash into a project, it does make you think twice, and you generally, make sure your numbers are right as well.
Yeah, sharpens your focus. We don't want, nobody wants that scenario where actually here's the keys, I don't stand to lose anything. It's not going to hurt me. You guys sort it out. Thank you very much. We've heard conversations like that in the past. So I understand us wanting to do that. So I think what I particularly like about this conversation is whilst we have spoken about valuations and numbers, it's really easy to get bogged down in the projects side of thing. I think what's particularly useful is we spent a lot of time talking around the person and the framework really that exists in lending and what. So hopefully what listeners can get from this is these aren't just a bunch of answers that says you do A, you will get B. This is sort of a framework and an understanding as to the thought processes so that you can then apply this logic to your deal. Ultimately, you need to go and make sure the numbers work and everything else makes sense. But this is the logic that you should be applying to how you structure and shape your deals going forward.
Yeah, I couldn't agree more that there's often a misconception that lenders are all about numbers, and of course we are. But for me, it's more about people. If we've got a big deal kicking around, we like to make sure our numbers are right, and we want to try and win this deal. But I would say 9 times out of 10, probably 99 times out of 100. If that deal is a deal that we want to win, we will win it because we will say, well, let's meet the person. Let's meet the individual. Let's meet the client, the broker, the accountant, whoever it may be, on site at the security address, ideally. If not, let's go and have a coffee with them, or they can come to our offices and we'll sit down and we go, right, who are you? What is it about you that we want? And as soon as you see white to their eyes, shake someone's hand, get to know them, build a relationship, you go, okay, you're a guy that as a lender, we're going to want to work with. Or, Mark, sometimes I'll be honest, we meet these people and go, do you know what? We're out. We don't, you folded like a pack of cards under pressure when we've gone into your numbers and gone into your experience. It is all soft equity. It is all not your own money going in. You've said this, but this is the actual reality. You've got these projects in the background, but you were never part of them. You were always sort of the silent JV guy, so you never got your hands dirty. So meeting someone, and we don't do this for every deal, of course we don't. Certainly for the bigger deals, big deals, and we're talking, £1 million plus, it sounds a heck of a lot of money, and it is, but there are multiple of them out there, and they are all over the country, not just South East and London. I've done 2 or 3, funnily enough, in the Cardiff area. And it is just about meeting that person so they can get comfortable with you as a lender, because let's face it, most people have never heard of Octane Capital. They've heard of HSBC, they've heard of Lloyds and Barclays and NatWest, but your specialist lenders, they wouldn't have heard of them unless they've used them before. So you've got to kind of sell yourself, and you've then got to know who you're dealing with. And like this, Teams and Zooms all are great, but face to face, if you can do that, you win all the deals, and that for me is key. And that's what I say to my guys in the teams. We need to go out and see certain amounts of people, because people buy from people. There's hundreds of bridging lenders out there who, let's face it, are all 0.6 a month up to 1% a month and a bit more. So many nuances and differences. But if someone comes in and goes, do you know what? I like, your product is decent, compared to what's out there. You as a person, I can get on well with. You pick up the phone. Sounds as though you know what you're talking about. I can pick up the phone to the underwriting team as well, which is really important, because, the sales and the front of house are great, but we don't sign the checks. The underwriters sign the checks, the credit managers sign the checks, they do the dirty work, they look through your 70-page valuation reports and pick bones out of it. So, but can I speak to them? Yes, you can. That's the point of it. Pick up the phone to them. We want you to have communication. And the argument is, a lot of people say, I can't speak to the underwriters. We want you to speak to our credit managers, underwriters, because it gets things done quickly. Let's cut out the BS. Let's get straight to the point and go yes or no to this question, yes or no to this question, show me this, I can't provide it. Well, we need that because we need to see your evidence. Or it might be a case of, we like this, I can't provide it. Okay, well, can we get round it by looking at something in a different angle? So it's working with people, and in a small company, like HSBC's vast company, thousands of people, maybe your deal would get looked at quicker in a smaller company because I've got a deal on my desk now, right, let's have a look at it, bang, right, this is the next deal. Whereas, in larger companies, it might be put on someone's desk in a big pile. That deal is important to this lender. You are important to this lender. Well, let's meet together. Really important for us.
Yeah, and it comes back to, and I've worked for HSBC for years, and it's changed since I've left. I've been gone now 8-10 years, whatever that number would be, and as they're under pressure to lend money out at lower rates, then the deals fall into a process as opposed to a person, and so on and so forth. So there's reasons, and look, banks are there's horses for courses, right? You go to banks for certain reasons, and you go to specialist lenders for other reasons. So, pick your path, if you like, from that perspective. So each has its own place in the whole economy of lending, from that perspective. So that's really useful as well. Just want to touch upon then, so thanks for that. And there's no surprises, the valuations have come into that, and bill costs and so on. And ultimately, as we say, we've gone then down the road of the person, which I think is perfect. Speaking of people, we did touch upon real quickly before we jumped on the podcast around high-performing teams, and you've obviously managed high-performing teams. I just thought it would be an interesting conversation, really, to sort of bring the podcast to a close, if you like, around what you've learned within high-performing, getting the most out of individuals and high-performing teams. Investors also sort of manage teams. They have trade individuals, trades, they have lenders. they have professionals, and so they effectively have to manage a team, right, on a project of these nature. So are there any sort of lessons or nuggets that you can share that are transferable skills to investors that they can use from your experience?
Yeah, I think I've kind of answered the question already, and it's something I always say, that people buy from people. So, I've worked for tertiary lenders over the last 20 years, worked with 20, 30, 40, 50 different people who are, some people are just naturally very good at their job. Some people need a kick up the backside. Some people need the sort of stick and carrot method. But to put it into the perspective of an investor, a property investor, have your team around you that you are comfortable with and that you can communicate with. Trust is a massive thing. Whether you're on your own as a one-man band or whether you're in a team of half a dozen, 10 plus, you need to have the professional people around you that you can trust and that will work with you. Now, whether that is your accountant, whether that is your solicitor, whether it is an asset manager that you have the ear of, whether it won't just be a lender singular, it will be a lender multiple. And from our perspective, going back one step, it's that broker, that intermediary, the mortgage advisor, call them what you will, who, it's a non-regulated industry, what we're talking about, but will give you advice accordingly. And you've got to trust those people, and counterintuitively, they've got to trust you. So building relationships is massive in this industry as a whole. But, if I was going to start my own property investment business, I would get a very small handful of people around me that I could trust and that I can communicate with clearly, and that they understand my business model and where I want to be in my next project. Now, we've got some brokers who we deal with, I sort of touched on it earlier, that give us multiple deals each year from the same investors, from different investors, and they built the model over a number of years. So it works. They've got people in place to do it. They don't particularly want to grow that model and be a big, conglomerate of property investment and do property investment seminars and all the rest of it. They could go down that route, but they've just gone, look, I'm very good at a certain aspect. It's knowing what you're good at. Are you good at being hands-on on a project? Are you good at the sourcing of property? Are you good at the numbers side of it? Are you good at the relationship and the communication side of it? Now, you won't be good at all 3-4 of those, but it's knowing what your strengths are, knowing not necessarily what your weaknesses are, but where you need help, and sorting that help, building strong foundations of relationships where you can call on these people to work for you, to work hard for you, but also call in favours where needed, but get to the right result. And if things go wrong, because they don't go right in every project, but it's how you react to that, learn your lessons from it, don't make those mistakes next time, and what can you do to avoid those errors in the future as well. So, with the team, again, it's an old phrase, but you're only as strong as your weakest link. Kind of work, and that sounds a bit negative, but work out where that weakness is. It's a bit like if you play poker in a room and you don't know who the fool in the room is, then the fool is you, right? If you don't know who the weakest link in your team is, it could be you. Well, why are you that weakest link? Is your broker the strongest and the best broker for you in this period of time? Do you have someone that you can rely on for valuation models, whether it be an asset manager or a QS or an old Ricks that you might know, and how are they performing for you? Your accountant must be an absolute whiz with numbers. The guys that you use for your works, how strong are they? What's that like? What's the relationship like with those? Are they just working for you, or are they working for several people? Do they work on their own project as well? Are they going to down tools on you at any time that you're going to be without people on site for 2, 3, 4 weeks and suddenly your project runs behind. It's knowing where, as I say, it's not a negative thing, but it's knowing where any potential downfalls in your whole project might be, and either plugging those holes or making sure you've got someone that can help with you. And it's a bit like, the BDMs. I've got a team of 10 people, internal and external, and I know, roughly the strengths and weaknesses of all of those 9 or 10 people. And I, give the praise where it's needed and wind them up and let them go where it's like, right, I know you're really good at this and you love doing webinars or social media posts or speaking in front of 15 people, 20 people, 100 people. And then I know there's other people who they like doing face-to-face and they don't like speaking in front of a vast team of 25, 30 people doing a presentation. Well, work to your strengths. So is it something that you've got to do and you've got to get better at? Or is it something you can give to someone else to do? Or is it something else you think, right, I'm going to roll up my sleeves and I'll do it myself because I'm the best at that. And then someone can come behind me and tidy up where needed and learn from me. I've gone back to people again, I think, haven't I? So it's so important. People have numbers, and numbers are incredibly important. But if you haven't got the right people in place in various different areas, your numbers go out the window. That's where we are, I think.
Yeah, no, I agree with all of the above, and just a few things I've just jotted down, which I think can help with that as well. So some of the things, we manage a team here, all high performing, really, really good at what they do. Quick plug for us, of course. Very much about keeping standards high. So us as the owners of the business, making sure that we do what we say we'll do when we say we do it is that old thing as well on customer service. So, if you say you're going to meet your builder at site at 10 o'clock on a Tuesday morning, be there at 10 o'clock on a Tuesday morning, not 20 past. If you are sorting out materials or whatever, and you say you're going to get there by Friday afternoon so that they can do that, get it there by Friday afternoon. If it can't be there, then communication is key, that you're having that conversation. So absolutely keep your standards high. That means that others will know what to expect from you. And then it's quite easy to set the bench as to what you expect from them in that regard. So you can expect that to be reciprocated. Clearly defining their roles. So especially if you've got a painter and a decorator, a plumber, a plasterer and what have you, you'd think that their jobs are quite, you do the plastering, you do this, but there is going to be overlap. So making sure that everybody's clearly defined as to what they are, your solicitor, what their role is going to be in the position, the broker and all of that sort of stuff. So that just means that if you clearly define the responsibilities, if they don't meet the responsibilities, there can be no question. It comes back to the standards pieces. Look, it was clear what they were from the outset. So an example would be on clearly defining the role of your solicitor, which you would think that's just simple. We're dealing with a client at the moment that bought their investment property cash, buy to let, instructed the solicitor to buy it in the limited company, paid the money from the limited company, and transpires they bought it in their personal name. And they found that out yesterday, having had the property for 3 years. So there is clearly defining what it is that the expectation is, etc. So something that's broken down in that chain of communication there. And as you say, making sure you've got the right people in the right role. So you may have the best builder in the town, city, what have you. However, if you don't get on as individuals, that's probably not going to go too well. So just making sure you've got the right pegs in the right holes. Then I guess brokers. I talk about this. Look, brokers can be much of a muchness. We should all have a level of expertise and experience. It then comes down to personality. If you put all of the best ones in a room, it's which one do you get on with the best? Because we've all got access to the same lenders. We've all should have the same knowledge. It's just who can you work with the best, really, off the back of that. So those are a few points on the high performing piece as well. I think that can really help you on your investment journey going forward. I think that's a great place to leave it, actually, off the back of that. And thank you ever so much for joining us on the podcast. It's been great to have a conversation. Good to hear, where people sit in the overall process, certainly from a borrowing perspective on that. Is there any last comments or thoughts that you want to share before we wrap up?
No, I've totally enjoyed it, Mark. I could sit and talk all day, really. I think it's got to be a passion, isn't it? I certainly wouldn't want to play at it. A lot of people call it it's a bit of a hobby, or it's a bit of an income, or whatever else. And one of the things I've just written down here is you've got to treat it like a business. So if you're buying your first, second, third, I mean, if you've got 50, 100, it will be your business, obviously. But if you're sort of starting out and you're in the low numbers, you've got to treat it like a business, set targets, track cash flow, budget for voids and repairs that people never talk about. The weather we've got today, how many boilers have gone on the blink and need replacing at, a couple of £1,000 each, and where are you going to find that money from? And it just treating it like a business, getting the right people in place, and knowing your numbers, and that'll be the really good start to a successful business, I think.
Yeah, absolutely. As you say, don't play with it. This is a capital intense industry. Things can go wrong quite quickly and spiral quite quickly. So staying on top of things is the way forward. Absolutely. So and I think as I say, that's a great place to leave it. So thank you very much, Richard. I really appreciate your time on the podcast today. Really enjoyed our conversation. And hopefully we have a fantastic 2026 and look forward to working with you in the future.
Great stuff. Thanks, Mark. Thanks for your time.
Fantastic. There we go. So I hope you enjoyed that. That was Richard Deacon of Octane Capital, a short-term finance lender, a specialist lender that we have worked with in the past. So hopefully that was really useful for you guys. We were keen not to talk around the product. Instead, we wanted to share with you some of the logic that goes into some of the decision making, what they're looking for, what they're not looking for, why certain decisions happen the way they do, why there are nuances, and so on and so forth. So, as I say, hopefully you were able to pick out some nuggets from that and apply that to your next deal when you're looking at how you're going to fund it. And as always, if you need to speak to us, you know where to find us. You'll find our details in the show notes, as too will you find Octane Capital's details as well. So thank you very much for listening. Hope you found it useful, and I shall see you on the next episode. Thank you. Take care, guys.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.